We're being cautious in our investment strategy, and we're making sure we're not taking 80% leverage or 85% leverage. We're capping it around 65% maximum to make sure we're not over levered on any deal.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey everyone, welcome to today's show on Wealth Strategy Secrets. We've got another awesome show for you guys today. Today we're joined by Bikran Sandhu. Bikran is the COO, CFO, and co-founder of Rise 48 Equity and Rise 48 Communities. Bikran's main responsibilities include overseeing underwriting, asset management, accounting, finance, and treasury at Rise 48. Prior to Rise 48, Bikran worked at PwC and CNM in audit and assurance services, where he audited Fortune 100 companies as well as pre-IPO companies. He also has a professional background in management consulting services related to Sarbanes-Oxley compliance, risk advisory, and transactional accounting advisory services for Fortune 500s. Bikran holds his BS in economics from UC Irvine, and he resides in Scottsdale, Arizona with his wife, Alice. Bikran, welcome to the show.
Yeah, no, thanks, Dave. Thanks for having me. Really appreciate being on here.
Yeah, you bet. I've been looking forward to this discussion. I think the audience is really going to, enjoy the perspective that you bring to things, and really reminds me back to my consulting days, because I was doing, business consulting, technology consulting as well. So I understand, the importance of, compliance for, top Fortune firms, right, and how that works. And when I kind of translate that to, personal finance, right? To me, it just seems like this whole world of financial engineering, right?
Yeah.
It's how you can really understand, these basic concepts and tenets, and then put them to work in a strategy that really, maximizes those things for the best, type of outcome. And I think a lot of people really miss that, right? Because, we're kind of trained by Wall Street to just say, hey, you're not smart enough to manage your own funds, leave it to the professionals. And so they're just kind of doing, that work for you. So,
exactly.
So why don't we get started and, tell the folks a little bit about, your background, how you got into that space, and what really ultimately led you into real estate investing at Rise as well.
Yeah, no, definitely. And thanks for the intro there as well. I think that covered a lot of the basic points there. But, I graduated back in 2012 from in California at University of California, Irvine, and moved directly into auditing. So I started at Grant Thornton, spent about a year there, and then went to PwC, spent about 3.5 years there, and really, got an understanding of how companies operate and how their financial statements are represented to the data, to the world, essentially. So, as we're going through audits and looking at different companies, you start understanding the risk factors of the various companies, what to really kind of hone in on, what type of systems are in place to make sure, you don't have fraud occurring, or you don't have misstatements occurring. So for the first 4.5 years, really got into the business of understanding different companies and medical field, technology field, and real estate fields, and understanding, what the key metrics are that they look at and what their investors look at to make sure those companies are still doing well. So, I didn't have any financial background before then. I was in college. I had an economics degree. I'm not, a financial analyst by any means going into this industry. But as you kind of go into audit, you really kind of understand from, point A to point Z, essentially, for the company, and how it takes its raw materials and turns it into profitable goods and how it returns equity to investors. So that was very helpful. And I think the biggest thing that I really learned was really Excel skills. Coming in, I hardly knew how to use Excel. Colleges don't teach you the day-to-day on what you need to do to be successful in life. So starting with the PwC and Grant Thornton really kind of helped me understand my Excel skills, how to manipulate data, how to understand data from a different perspective, and not spend years trying to figure out how to do it. It was really helpful. And then after PwC, I really kind of got the bug of kind of wanting to do a little bit of management consulting. I wanted to, instead of looking at financials after everything happened, I wanted to start looking at financials while they were, being created. So going in, helping companies buy other companies, sell divisions, or reorganize or restructure themselves to be more profitable. That was very helpful. I really wanted. I got a couple of clients at PwC where they were going through a restructure, kind of learning about how they were, reorganizing their workforce. And I had some good ideas, but obviously, as an auditor, you're a third party. You can't really do any management consulting. So when I left PwC, that was where I wanted to go. Was a little bit more on the consulting side. So that's where I joined CNM. Spent about 4 years there, and our first client, it was a Fortune 100 company that was buying another one of their competitors, and we were in there helping them understand how to value that client. They've already paid the purchase price for it, but now they need to allocate it to all the assets that they got. How much is going to go to goodwill? How much is going to go to the accounts receivable and what they're going to collect or not collect? Instead of looking at it as an auditor, once everything was done, I'm looking at it and helping the company decide how to kind of allocate the different values. So that was super helpful. And throughout my career at CNM, really kind of helped companies also implement processes. So to make sure that there wasn't any holes in their financial process, which could lead to a financial misstatement. Kind of help companies design those processes, test those processes to make sure they weren't breaking, and then also helping companies, value the businesses they were going to go buy. And that's really where my financial background really kind of kicked off. Was I was reviewing these 409A valuation reports where I helped companies kind of decide, how to kind of value the different assets they were looking at and what they had acquired and how to allocate it all. And that's at that time I had a couple of real estate clients as well. So kind of piqued my interest, how these companies kind of worked. And at the time, I was also with my then girlfriend, now my wife, Alice. We were looking at, how long we would have to essentially work and, be in the W-2 position for our entire lives, essentially to live the life we wanted to, and decided that, hey, why not start supplementing some of this income with passive income? So in 2017, 2018, after being at PwC or CNM for about a couple of years, 2-3 years, we started looking at passive income opportunities, like multifamily, single family, flips, rentals, house hacking, short-term rentals. And, living in California at the time, it's not very friendly to multifamily investments, and it's not very friendly to single family residential. You're not going to do a BRRRR method in California, especially in SoCal and LA area. So really the primary passive income, quote unquote, strategy that we had was fix and flips. So, and you can imagine, Dave, it's not, that is not passive in and of itself. We're looking at deals that you have to buy for cash for $300,000, spend $80,000 flipping it, and then selling it for $450,000, $460,000. After you take out all the closing costs and the broker fees, you're making maybe 10, 15K on that flip. And the entire time you have to be on site managing the contractors, making sure they're doing their work. So it's really active income. And instead of supplementing our W-2 income, it was going to be essentially replacing it, because I couldn't go to work from 9 to 5 and also watch contractors. So slowly, my wife and I started looking at looking at single family rentals outside of California because it was non-existent there. And as we're kind of modeling out the finances, we're realizing that having a property management company run these single family homes was essentially eating our profits. So we'd have to essentially buy around 20, 30 single family homes for it to kind of make sense for us to actually go out and buy these homes. And at that point, I was like, well, why don't we just do multifamily? We're already there, in terms of when it's going to become profitable. Why spend 5, 10 years like buying these single family homes, getting it to a point, and then all of a sudden realizing, oh, just do multifamily straight away. And that's how we got into multifamily. We, at the end of 2018, beginning of 2019, we really started looking at passive income opportunities from multifamily syndicators. We invested in a couple, and as we're kind of looking through the entire process of going from identifying a deal all the way to selling it after executing your business plan, I realized, I had a very strong advantage in financial modeling, and I needed someone to kind of help me with supplement my skill set with the, broker relationships and capital relationships. But as long as I find that person, I can go in and do the financial modeling, asset management, run the company, and add my value from that perspective. So, and February 2019 was our first deal that we bought. It was called Silver Oaks, 36 units, and I bought that with Zach Haptenstall and Robert Shefchik. They were our principal partners there, and Zach was building out those broker relationships with investors, with the investment sales teams, and then he was also building out his capital relationships with investors. And Robert was, he had a construction background, so he was helping out, making sure our business plan was designed appropriately. So we went, all in, just our money. The first deal that we bought was 36 units. I invested $150,000 of my own cash that I had saved up from my years of working at PwC and at CNM. And that was really all my life savings, honestly. I didn't have a lot left after that. I was really kind of living paycheck to paycheck. And then as we started executing our business plan on Silver Oaks, the property, we realized, hey, this isn't rocket science. We can take what we're doing here and kind of replicate it on other assets. And then we started buying other properties. So that's really how it kind of kicked off, my background and how it kind of melded into multifamily.
Yeah, that's such a great story, Bikran. I know the listeners are going to really kind of connect the dots there, but that's really just such a great trajectory, right? As an entrepreneur, where you really identified, your skills in the audit business and process and everything. And I also kind of came from that space as well, like I said. So it's fascinating to me because I really think about, not only building a business, you've got to have the process, but the process of wealth building is actually a process in and of itself, right? So you started to kind of go through that journey, right, and take that to the next level by then partnering with others, right, with their unique ability, exactly where they fit into their lane, and then just kind of scaling that up. Was there any, light bulb moment that you had in terms of getting into, it seems like there was two big points for you. One was getting into passive income in the first place. Mm-hmm. And then the second would have been, for you to just go for multifamily, because that was a big bet that you made.
Yeah, no, definitely. I think when we looked into getting into, real estate investing, like even now, like my wife and I, we didn't have kids back then. And we were essentially telling ourselves like, look, if we're going to take a leap of faith, now is the time. Like we don't have dependents, we don't have someone relying on our income. So if we go out there, try to do this and crash and fail, it's all right. I'm a CPA. I'll get a job. There's a shortage right now. If something happened tomorrow, I can easily find a job out there. My wife has an HR background. She can find a job in HR. It's not a big deal if we were to kind of jump into this right now and try it out. But what we don't want to happen is, when we're 60, 70 years old, kind of built up everything, and now we're looking back and saying, oh gosh, we could have done something different and could have arrived at a different point. So taking that leap of faith of, hey, we want to get into this and really kind of be the general partner was the first light bulb moment where we decided We wanted to get into this, and we wanted to make sure we could build something out. So changing our mindset from let's just kind of dabble in it and see what happens to, okay, we're going to do this. We're going to make sure we're going to be successful. And if worst case scenario, we go back out, we go back to our day jobs. That's the worst case scenario. We were able to do that. And then the second light bulb moment was, as you kind of mentioned, like I had identified my competitive advantage in the industry, and I wanted to have somebody come in and supplement that advantage. So, Zach and Robert, they were perfect supplements where I don't have the construction background and I don't have the relationship background that Zach has. But I have the financial modeling skill set. So they don't have those skill sets, so we're not stepping on each other's toes. But I can go out, run a business, from a back office perspective, and they don't have to worry about those aspects. They can go out and make sure properties perform from a physical and from a relationship perspective. That was really critical.
Yeah, that's absolutely key for entrepreneurs, right? Scaling businesses. It's staying on your lane, having the right focus with that, and then you can really get, exponential results. Do you have a particular wealth strategy that you're following today, Bikran, in terms of, what you're doing? I mean, in addition to the business, but what you're doing personally?
Yeah, so mostly, most of our wealth is kind of tied up into our company because we're running it day to day. We know where the trajectory is at, and we want to make sure that our investors know as well that we're not just running this as a side gig. Back when, in 2019, we had acquired a few properties. In 2020, we had acquired a couple more. Rise 48 was really kind of a side gig for us. We had our W-2 jobs. We were kind of starting to build up this business, but it wasn't really our main bread and butter. In 2021, my wife and I essentially quit our day jobs and moved to Phoenix and started building our Rise 48 to the plan that we wanted it to be built out at. And throughout that process, it involves significant amount of cash and inflow into the company to build it out. And you've probably heard this, Dave. Like, the first couple of years of being an entrepreneur, you're really not going to make a lot of money because you're going to be putting all that money into your business. And that's what we did. We lived off our life savings, and for the past, 3-4 years, we've been investing money into building out this company. So even when we go out to, as we're buying new deals, we don't buy those deals and give it to a third party to go out and manage those. We manage everything in-house. In order to build out that management company, we've invested north of 7 figures into that company to make sure it's stable, it has the infrastructure it needs to be operating, and we're also building out our construction side and making sure that anything that we're representing to our investors in terms of our business plan and operations, we're able to control those aspects as opposed to handing it off to a third party and losing investor confidence or losing any sort of wealth that we've generated because we're not performing on our properties. So, from our wealth generation side of view, our investments into our company and into our real estate has been really critical because that's been able to help us really exponentially grow that wealth because we believe in the product that we sell. So we invest our own money in there and we invest the money into the company.
Yeah, absolutely. I think, people are always thinking about it from an investment standpoint, like what other investment vehicle can I get into? But it is interesting to look at, your own business, right, as the investment itself. How can you drive valuation in that, and what type of return? Typically
Right.
businesses will yield a higher return. They come with a little bit more risk, and
Right.
you're definitely all in. But just to give listeners a sense of the gravity of what you guys have accomplished is really impressive. And tell folks, in terms of your current footprint, assets under management, markets, your current expansion right now.
Yeah, so to date, we've acquired about 42 deals across Phoenix and Dallas. We started off in Phoenix. We acquired around 30, I want to say 39 properties out there before we started expanding out to Dallas and looking at deals out in Dallas. And the reason was, we wanted to make sure we had the blueprint for success established in a market before we take that blueprint and replicate it in a different market. So that's our strategy in terms of expansion. But to date, we've acquired about 42 assets. We've sold 11. So we have around 31 under management, and most of those properties, again, are in Phoenix, and we're starting our footprint growth in Dallas. And our goal over the next at least for the next couple quarters, will be keep doing more and more Dallas deals, build out the infrastructure, and sustain the infrastructure out there, and we, our goal is to continue buying at least a deal a month for the foreseeable future. And last year and the year before, or 2021, we bought about $500 million in assets. Last year, we bought about $800 million in assets. So as of right now, under managed total transactions that we've done, we're around 1.8 billion. And we have around, I want to say, 1.4 billion under management in our portfolio, and we're continuing to grow that.
Yeah, that's such an awesome scale in such a short amount of time too. So kudos to you guys. It's really, really impressive. In terms of that as well, can you speak from a competitive differentiation standpoint? Because I know some of the markets you operate in, there's some big players, right? Including some institutional players, right? In those markets, and you guys pretty much kind of almost came out of nowhere, right? And are going really toe to toe with them. So, what would you say is that key differentiation for you guys?
Yeah, and just kind of give a perspective of Phoenix. Majority of our competitors, as you mentioned, Dave, they are institutional players. We're competing with the likes of Blackstone, Tides Equities, Western Wealth Capital. Most of them get equity from joint ventures. They're not really syndicators. Western Wealth, for instance, started about 10 years ago, I want to say 15 years ago. They started off as syndications, but now they're partnering with, joint ventures such as KKR, which is a huge player in real estate, to buy deals. So a lot of times when we're going after, marketed deals, we're having to compete with them on best and finals to get to the best price. And, certainty of execution has always been very important for us. We're coming in as a brand new player. We're buying deals from sometimes institutional players, and they want to know that, when we get a deal under contract, that we're going to close it. We have never gotten a deal under contract that we have not closed to date. And we have no intention of going after deals that we cannot close, or going after deals where our equity is not lined up. So we always make sure that if we're going to go after a deal, that we're going to close that deal within 60 to 90 days, which is typically what the PSAs require. So, the very first deal that we bought through actually was through Western Wealth Capital, was a seller. We got grilled a lot, honestly, with the questions on, hey, are you sure you're going to be able to close this deal? The total check size for your equity is around $6 million. You guys have never really raised money before, and we had to go hard on earnest money, which wasn't really normal at the time. We had to, go about $300,000 hard earnest money day one without even doing any inspections. So that was a lot of risk for us that we were taking, but we believed in the deal. We had at that time we were using third-party property management, but we had our property manager go out to tour the deal with us. We were talking to vendors, asking about, hey, have you had any history with the roofs at this property, or any plumbing history at the property? Like, let us know what you guys think. We'll go ahead and model it all in. So we were going in prepared, but it was still some sleepless nights, making sure that we've got the deal under contract and now we have to perform. So raising money for that first deal was very it was difficult. It was the first time we were doing a deal, but we were slowly kind of building up that track record, which now when we go out to, the market and bid on a deal, we have this entire record of, hey, we've closed 42 of the 42 deals we've gotten under contract. We have, no intention of retrading the buyer, retrading the seller, on the deal itself, because we don't retrade. We'll budget very heavily on CapEx, or capital expenditures, on our side, so that when we do our due diligence and when we do our loan calculations, we know that we have levers we can pull if something comes in higher or lower. because we've kind of overcapitalized the deal on the front end. And we've never had to go back to the buyer and say, or the seller and say like, hey, look, your plumbing came in really bad, so we need a credit for $500,000 or something. We've never had to do that because we have always kind of built it in on the front end. And it makes the deals a little bit more juicier, to be honest with you, when we get it to the investor, because now we've cut back on CapEx. We've gotten more loan proceeds than we needed or that we modeled on the front end. So it makes the returns a little bit better for investors. We'll still show a conservative estimate to the investors. We will never show, the plan A, which is really to kind of get out of a deal within 3 to 4 years. We'll always show a plan B, which is, hey, the market's going to stay in a recession for the next 4 or 5 years. We're not going to experience any significant rental growth, and it's going to take us 5 years to affect our business plan and get the returns that we showcase in our investment decks. So that's the expectation we set for investors. But the 11 deals that we've sold, it's taken us around 18 months to achieve the business plan that we expected to achieve in 5 years. So that's part of the market, but part of us actually doing what we said we're going to do in the business plan.
Great. So given some of the market conditions, right, 2023, such a rapid rise in interest rates we saw last year, not really sure, what's gonna happen with that. We've got all these geopolitical events going on, and a lot of people in commercial real estate, especially multifamily, some people are sitting on the sidelines waiting for opportunities to strike. Other people are having challenge with the capital markets in terms of getting the capital required for deals, or things just not necessarily papering right. So how are you guys really positioning yourselves to have such deal flow in this market?
Yeah, that's a great question. This is a volume game. CRE and multifamily is completely a volume game when it comes to finding the right deals. We, in Dallas at least, we started looking at deals in November, December of last year. To date, we've underwritten over 120 deals in Dallas. And of the 120, I can tell you 95%, our bid ask has been just so significantly different, where the seller wants, X, and we can get to X minus 25%. And that's very critical in knowing where the market's at today, because seller expectations have still not come down. Buyer expectations have not come up because of the volatility you see in the CRE industry. And the 5% of the deals that do work, we try to pursue them as best as possible. But we're not going to win every deal that we go after, or if we're going after a deal, it might be too late because someone else already snatched it up. So of the deals that we've underwritten, 3 or 4 have really kind of penciled, and we've aggressively pursued all those, and we've gotten those under contract because, as you mentioned, Dave, a lot of the people are sitting on the sidelines. They don't know where the interest rates are going to go tomorrow. They don't know what's going to happen to the debt market. They don't know what's going to happen to the economy. But our thinking is that every deal out there, if there's a good story behind it, we're going to go after it. So the deals we've bought in Dallas so far have been primarily distressed deals, where the sellers had either a balloon payment come up, or they're running out of cash reserves, and their interest rates have shot up, and their interest rate cap is expiring soon. So they're going to either have to shell out money for the cap, or they're going to have to start asking for capital from investors. So we're either going after very motivated sellers or very highly distressed sellers. Any deals which are, the buyer bought it in, say, 2021, 2022, they have a 3-year, 4 or 5-year loan, they're not distressed. Those sellers typically are not working out based on our model because their expectations are a little too high. But the deals that do pencil are the ones that are distressed, or where you have motivated sellers that just want to get out of the deal because they don't want to do those deals. And we're taking a cautious approach on our end as well. We know, I personally believe interest rates have kind of hit the peak on where they're supposed to be, and that's based off of what the Fed is saying, where they want to get the interest rates higher than the inflation rate. And as inflation starts coming down, you should theoretically see the interest rates also come down over time. But I don't think interest rates are going to expand to like say 6, 7, 8, 9%. I think 5% is where it's going to cap out at. Nonetheless, though, we're essentially buying interest rate caps across our deals to make sure that our interest rates do not go up in the future. So even if the Fed increases rates by, say, 100 basis points at the next Fed meeting, our interest rate is going to stay static. And because we're buying a cap exactly where the SOFR is at or below where SOFR is at. So we're paying for that up front. We're paying a prepaid interest on those deals up front. But what's essentially happening is we cannot offer a high enough purchase price because we're taking proceeds from the purchase price and allocating it to the interest rate purchase. So instead of offering, say, $50 million for a deal, we can only offer $48 million because $2 million is going to go towards buying a cap for that specific project. So we're being cautious in our investment strategy, and we're making sure we're not taking 80% leverage or 85% leverage. We're capping it around 65% maximum to make sure we're not over levered on any deal.
Yeah, good point. So maybe you can explain to the audience a little bit on this interest rate cap, right? Because a lot of people are in deals right now, and all of a sudden they're seeing, margins being squeezed by the increase in interest rates. But yet some people have the interest rate cap. So can you help educate everyone a little bit on the cost of an interest rate cap and how that actually works?
Yeah, of course. So the way interest rates are calculated for like debt funds is they'll take what's called the index, which is the secured overnight financing rate or SOFR, and they'll add a spread to that index so that you have a total all-in interest rate. So if SOFR, for example, is 1% and the spread is 2%, your total interest rate is 3% on a deal. Typically, a lot of the debt funds are variable rate, meaning that they float over SOFR. So when SOFR starts going up, your interest rate starts going up as well. So when you're buying a deal, let's say you don't buy any interest rate caps at all, and SOFR was at, say, 0.05%, and your spread is at 3%, your interest rate when you bought the deal is at 3.05%, which is 3% spread plus the 0.05% SOFR. Well, over 2022, SOFR went from 0.05% to around 4.25%, and by the end of 2022. So you can imagine your interest rate, which was, if it wasn't capped, went from 3.05% to 7.3% in just 1 year. A lot of the deals, when you have leverage up to like 70, 80, 85%, that interest rate increase is not calculated on the front end in the underwriting, and it cannot be supported by the property essentially because there's just way too much interest rate expense coming on in way short of a time. So your interest rates essentially more than double in that time frame, but your cash flow hasn't doubled. So if the property is making, say, $50,000 in NOI and paying $40,000 in interest expense, your cash flow is $10,000. But by the end of 2022, if your cash flow if your NOI hasn't increased and stays at 50,000, your interest expense went from $50,000 a month, $40,000 a month to now $80,000 a month. Now you're losing $30,000 every single month in cash flow because interest rates went up so high. So what most syndicators do or should be doing is they buy interest rate caps. So if SOFR, which is the index, goes above a certain number, then the interest rate cap comes in and pays the interest. So if you have, for example, let's say you have a cap at 2% and SOFR goes from 0.05% to 4%, the cap provider is paying the interest above 2%. You're still paying the interest up to 2%, but everything above 2% is being paid by the cap provider. So that helps pay the interest down a little bit from the cap provider, but not a lot of people are buying caps in the money. They're buying the caps essentially where SOFR is at currently or where SOFR is expected to be in the future, just to get the cost down. But we typically buy, caps right now at or below SOFR. So what happens is if SOFR right now is at 4.25%, we'll buy a cap at 2%. So even if SOFR goes to 6, 7, 8, 9%, our cap provider is paying that interest. We're not paying that interest from our cash flow from the property. Our cash flow is static as long as income stays static.
Yeah, that was a great explanation. So you feel confident then over a 3 to 5 year hold period that once you have that cap in place, you're going to be good in terms of your underwriting and projections?
That's correct. Yeah. So
Yeah.
our earliest deal that we have under management, we bought that in June of 2021. Again, we bought 3-year interest rate caps on every single deal. So in June of 2024 is when that first deal's interest rate cap will expire. Well, the deals that we're buying, they're value add deals. We're not just buying a deal and hoping the market takes it to the next level. We're going to go in, spend money, increase the NOI, increase the value of that property. So the deals, one of the aspects of our business plan is doing interior renovations. And as we do interior renovations, we're slowly increasing the NOI. So across the portfolio, what we're doing is, hey, we used to renovate around 10 to 20% of the asset in the first year. Now we're saying, okay, we're going to renovate 60, 70% of the asset in the first year, because we don't want to take the risk of essentially being renovated at 50, 60% by the time the debt is essentially, the term is over. We want to be able to refinance out of the deal. So we're going to renovate everything that we own to 100% by the time the debt term is up, so that when the debt term is up, we can either sell the deal as a fully renovated turnkey product to the next buyer, or we're going to refinance the deal, hold it for a year or two, and then sell it when the market comes back. So we don't want to get caught in a pinch where we want to sell a value add deal, quote unquote, to the next buyer who might not be there. We want to renovate it 100% so that if the next buyer is not there, we can get out of the deal and get out of the debt product and move to a more stabilized debt product after the initial term is ended.
And where do you think people are really having issues? Is this operators, maybe inexperienced operators that, got into a product maybe 3 years ago and it's coming due now and they didn't do the underwriting for it? Or what would you say to that?
Yeah, I mean, so I'm on a lot of lists for, different sponsors that are going out and doing deals. And a lot of the deals that were being marketed in 2021 and 22 were value add deals where the sponsor was going to spend, $5,000 a unit and doing renovations and increasing NOI pretty substantially. Well, based on our construction management that we do, we've renovated over 1,000 units as of the end of last year across our portfolio. And right now we're renovating between 200 to 300 units a month across the entire portfolio. Renovating units is not an easy process where you just put one, company in there and they just renovate everything. You have to have oversight. You have to buy materials to make sure they're not gypping you on materials, and you have to make sure that all the timelines are being met and that the budget's being met. So having that oversight is very critical to the operations. And when we know what the price is for the materials because we're buying them all wholesale internally. And, we're typically budgeting between $15,000 to $17,000 a unit in the renovation expense. So when, I saw in 2021 and 22, a lot of these renovation expenses were going to be around $5,000 a door, and they were renovating 100% of the asset, I essentially looked at it and kind of was a little taken aback, thinking, okay, well, how are we spending $15,000 and they're spending $5,000 and they're getting the same rent bumps? So there's a couple aspects here. One, I think, is a lot of people kind of underestimated how much the cost would be to renovate these units, and they were taking old metrics to turn a unit, maybe add new stainless steel appliances, and that's all you had to do. Well, when you buy 80s value add, a lot of these deals are essentially trashed. So you have to rip out the flooring, put in brand new flooring, new quartz countertops, new shaker doors, because the old doors for cabinets wouldn't fit on the old cabinet boxes. So your expense is slowly increasing. And if you don't have any infrastructure to kind of oversee the construction side, your subcontractors are not going to spend as much time as it should be in renovating your products. So a lot of the distress that we're seeing, and one of the deals that we bought in February, the primary distress was they had marketed that they were going to renovate the property completely, and they hadn't touched any of the units. They had maybe turned them and just kept it cash flowing. But the moment that rents weren't going up 10-15% a year, their strategy fell apart because they hadn't renovated anything. Their balloon payment was coming up in March of 2023, and they couldn't renovate 300 plus units in just 6 months. So that's where you see the distressed hit. And I think you're going to see more and more of that over the next couple couple quarters, 3 to 6 months. There's deals that were bought in 21 and 22 where it was all value add play, and nothing has been done at the property level. And now the sponsor or the operator is in trouble because they can't refinance and they can't sell for a high value. So they need to get out of the deal, or they get foreclosed on because they haven't done anything at the asset level.
Yeah, really great insights, Bikran. If you could give investors just one piece of advice about how they could really accelerate their own wealth journeys, what would it be?
Yeah, I think whether you're investing in stocks or whether you're investing in real estate or any alternative investments, what you want to vet is not the company itself. You want to vet the management team. I think that's like one lesson I've kind of learned. I used to buy options and trade options at like my first options trades that I ever did was Tesla options back when they were releasing their financials on a quarterly basis. I think I invested like $800 on my first option trade, and I was betting that Tesla would go profitable in their first quarter, and they did, and I made about $15,000, and I thought I was really smart, so I started investing in like Google, Apple, Facebook, etc., and lost $14,000 because I didn't know what I was doing. So, as an investor, what you want to vet is a management company. If you trust in, say, the management at Apple or at Tesla, that is the company you want to invest in. And real estate is nothing different. You're investing in the company or the management company that you believe in. So the value add that we have is that we're finding deals that we think are going to be home runs for our investors. So if you trust us to do our job, you'll know that we have a box that we have to fit our deal into. And if that deal does not fit into that box, we're not going to present it to you to invest in. So every deal that we do, we get flack because a lot of the deals we do, the returns are very similar. And the reason is because we have to hit that box for our investors. Like, it's not like we're going after every single deal and we're changing our underwriting to make the returns more favorable to investors. We take a deal, put it into our box. If it doesn't fit, we give it back to the broker and say, hey, we can't go after this. So as long as you trust your underwriters or trust the team that you're working with, they'll present you good opportunities. You can underwrite every single deal yourself, obviously, and as transparent as the management team is, that gives you more faith in that team. But you want to make sure you ask the questions on like, hey, what's more important to me as an investor? Is it knowing the financials on the background? Is it knowing the people in the background? To me, I think personally, knowing your operators and how they do and their track record is way more important than any individual deal itself.
Excellent. Bikran, really appreciate you coming on the show today and providing so much value to everyone. I know I could continue to drill you with questions. It's been really an insightful discussion. But if people would like to learn more about you or what you guys are doing at Rise 48 or Connect, what's the best place?
Yeah, I think if you guys going to visit our website at rise48equity.com, which is the word rise numbers 48equity.com, and then we have a link there for setting up a call with us. Go in there, select my name, and then jump on a call with us, and we can talk about my background more specifically. And if you want to invest with us, you can invest with us through once we get you on our investor list. But you'll never see our deals marketed anywhere. We only go through our section Regulation D 506B offering, so we don't market anything. You have to be on our list to be able to get our deals. And if you want to connect with me on LinkedIn, you can find me there. Search my name. It's very unique. You're not going to miss it. It's Bikran Sandhu, and you'll essentially find me. But send me an email, bikran@rise48equity. Set up a call online, and you can find me. We'll try to be as available as possible.
Awesome. Thanks so much, Bikran.
Yeah, of course. No, thanks, Dave. We appreciate you having me on your show.
You bet.